All right, so now let's look at the hedge funds, basics, benefits, risk, return, etc. So normally hedge funds return are going to be more than equity returns, particularly when you're looking at the down markets. Because again, we've seen hedge funds have a variety of strategies. They are not typically long only, but rather long, short, derivatives, etc. And they're very unusual strategies. First of all, when you're looking at the variety of strategies that we look at in hedge funds, you'll have to understand that one hedge fund, maybe a short bias, will be doing very well over here because it is kind of having a negative exposure to the market, and a market neutral might be doing okay over here or okay in a flatter market or so, and maybe another strategy could be doing, maybe a long short strategy would be doing better over here than here, or maybe a fundamental value strategy might be doing better over here. So even different hedge fund strategies will be performing better at different stages of the business cycle. So because we've already discussed the strategies in hedge funds, and there is a huge variety in terms of hedge fund strategies. So therefore, at different phases of the business cycle, they're going to be performing in a very different way. But on an average, normally, hedge funds do a better return, give you a better return, provide a better return in the down markets. And also when the markets are increasing, because again hedge funds are not purely long only strategy, so equity starts increasing first and hedge fund returns generally lag equity returns. So equity starts increasing first, then hedge fund starts increasing later, right? Also, when you're looking at, I've already told you, different hedge fund strategies are going to be having different timings and all. Correlation of equity and hedge fund, of course, is going to be less than 1. We're not saying that it is going to be negative or very, very low, but it is definitely less than 1. If it is less than 1, there is diversification benefit. And over here, unlike commodities, see, in commodities, the idea was the diversification, the low correlation was a major aspect, was a selling aspect to invest into commodities. But when you're looking at hedge funds, they have good returns because they take unusual strategies, they take risks and all. Hedge funds are primarily there to make extraordinary returns, right? They're here to take advantage of mispricing, generate alpha. That is what hedge funds are trying to do. Commodities was not that. Commodities was more about inflation hedge. So what is the objective of investing into hedge funds? So maybe I'm not getting so much of diversification benefit. Of course, I'm getting some because the correlation is less than 1. Correlation is less than perfect, less than 1. So I will get diversification benefit. May not be as much as commodity, but I'm okay with that because commodity was not even adding that kind of return. But hedge funds, I'm expecting, is going to be adding a very good amount of return to my portfolio. And I have to be careful that diversification actually may not be as much as I expect, because generally diversification tends to, generally correlation tends to increase during stress market, during stress, during bad markets, during extreme markets, during negative markets, and that is when I needed correlation to be lower because I wanted my portfolio risk to be lower. Following this, easy, just rounding up. Next, when you're looking at hedge fund, this is important. These two terms are very important when I'm looking at a hedge fund index. So how do you construct a hedge fund index? I've already told you that when you're looking at hedge funds and all, the idea is that tired now. So when I'm looking at hedge funds, so basically what happens is that hedge funds do not have that kind of regulation in terms of disclosure and all. They do not have that regulation like mutual funds and all, that they have to report their earnings, they'll have to report all of their data and holdings and all of that. So there is a problem over here. Now, how do I get a hedge fund index? I want an index. I want to see how the hedge funds are performing. In India, we barely have hedge funds and the market's not very, very ripe over here. But I'm hoping and I'm assuming that markets are going to get better for hedge funds over here as well. But when you're looking at global hedge funds again, you would see more of hedge funds, parked in tax havens, Cayman Islands, UK, US, and all of these financial hubs and all. So when I'm looking at hedge funds, the problem is that they don't have that regulation in order to report. Transparency, reporting, etc. is not required. But I want to calculate a hedge fund index. I want to see how the hedge fund as an asset class is doing. Obviously, I want to see the asset class, right? I want to understand the risk return and all, decide how much of my portfolio do I want to invest into hedge fund, what kind of hedge funds I want to invest. So there is a lack of reported data. How does hedge fund index get created? Ultimately, those hedge funds who want to report their data, they will publish their data. Those hedge funds that publish their data, I'm only going to be able to take those hedge funds data and calculate my index. Now, which hedge funds are going to publish data? The ones that are successful or the ones that have shut down because of losses? The ones that are successful. And hedge funds are again risky. There will be hedge funds which will be shutting down, and those which are giving negative profits or performing poorly, do you think they're going to advertise their losses? Of course not. Because ultimately, which hedge funds would want to advertise? The ones that are gaining profit. Why? Because so that they can attract more investment and they can charge that kind of fees, because ultimately they're getting good amount of management fees and all. I had just very briefly told you about management fee and incentive fee and all. Whatever, say for example, you invest 100 crore in a hedge fund, you'll get a 2% management fee, let's say. So 2% of 100 crore, 2 crore you're getting just to manage, irrespective of whether it's making a profit or loss. And if you make profit, then maybe you'll get some share of the profit also. Tell me, are you following this? So when I'm looking at this, the hedge funds which are performing very well, they are going to be the ones who will be reporting their data. So don't you see that my sample, my hedge fund index is consisting of only those hedge funds data which have published. And who have published their data? The ones that have been doing well. The ones that have shut down, the hedge funds that have shut down because of losses, etc., they are not a part of my data. They are not a part of my sample. Don't you see there is a bias towards the survivors? There is a survivorship bias. There is a survivorship bias. There is a biasness towards the survivors. Only those hedge funds which have performed well, which have survived and reported their data, only those hedge funds get included into my hedge fund index. There is a major survivorship bias. It's a sample selection bias, where your sample is selecting only those hedge funds which have survived and published their data. Don't you see that the returns are going to be upward or downward biased? Upward biased, because I'm biased towards, if I want to really see how hedge funds are performing. See, understand, before the hedge fund has shut down, I do not know which hedge fund will do losses and shut down, which hedge fund will be successful 5 years later. So at this time, like today, if I want to decide, I will have to invest in 5 hedge funds. It is after 5 years I'll get to know which hedge funds had survived and which had shut down. But in my index, those which shut down, they will never publish their data and they will never get involved in the become a part of the index. Are you following this? Are you understanding this? So there is a major survivorship bias, which is a major problem with hedge funds and all. Next is your backfill bias. Now what happens is, suppose a hedge fund has started today. Now obviously it's not that today I'm going to start a hedge fund and tomorrow I will get so much of investments and everything and everybody will give me hundreds of crores, hundreds of millions of dollars to take these risky strategies and invest. You will have to start, you will have to market. Maybe in the first year you're having an AUM, an asset under management, the amount of money you have got in investments, maybe 10 million or 15 million, then you become 40 million, next third year you become 50, 70 million, you have a proven track record, you have a name in the industry, now you're getting investors who are willing to invest, and now you breach the 100 million AUM mark. And what if the hedge fund index is including only those hedge funds which have at least an AUM of $100 million? So after 4 years or 5 years of you achieving the $100 million mark, then that index is going to include your data. Say suppose I will start a hedge fund with 10 lakh rupees. Will that get included in hedge fund index? Obviously not. So let's say the hedge fund index has got a a level of a benchmark beyond which only you will be you will be included in the index. Now don't you see, in the 5th year my AUM crosses 100 million and I report my 5 years worth of data to the index, and that index is including that 5 years of data. In the first 4 years, did you know that in the first 4 years, did the index include that hedge funds data? No. It is in the 5th year, you've included all the last 5 years worth of data. And obviously, if you have performed well, only then you would have crossed 100 million AUM. So again, there is a bias because you're backfilling data. So today my hedge fund index has got 5 years of hedge fund index of that hedge fund's data, which was not there in the index in the last 4 years. Today it crossed 100 million. Today I'm using and including that fund in my index, and I'm including that last 5 years of data. But that hedge fund, you did not know 4 years, 3 years, 2 years, 1 year back that is going to be crossing an AUM of 100 and that is going to be a successful hedge fund, and I want to include that in my index. You did not know that earlier. Today suddenly that hedge fund has become successful after 5 years and it is reporting, okay, last 5 years data is this. So hedge fund index also includes that, okay, last 5 years average hedge fund data is this. That is backfill bias. And don't you think again it is going to be upward biased? Because only those data will get backfilled that have been successful, because only the successful ones are going to get included in the index. Only the successful ones are going to be reporting their data, publishing their data. And again, you cannot do much about it because there is going to be this industry does not require disclosure. So you cannot calculate every single hedge fund that have shut down. But with experience, you'll understand that what percentage of hedge funds are probably going down, and you'll at least as an analyst or as an investor, you need to understand that yes, there is a survivorship bias, yes, there is a backfill bias, and I need to remember that, I need to know that. So that when I'm expecting that if this index is giving me an expected return of let's say 23-24%, I know that I need to revise it to 18. 23-24 is not achievable, that is not possible. Tell me, are you following this? So those hedge funds which have been successful in business for a good amount of years and have a larger AUM get ultimately represented in this index, which is not a true representative of the hedge fund asset class, because a hedge fund asset class does include those hedge funds which do not become successful. After becoming successful, you're including here. Doesn't make sense. Are you understanding? कोई मेरे को पहले बताए ना कि ये हेज फंड अच्छा है, इसमें पैसे डालो, भरने के बाद बताओगे तो क्या फायदा हुआ? After increasing, you're telling me that this hedge fund is successful. If you're able to tell me before, so that I am at least able to invest. Tell me, are you following this? Another problem is that when you're looking at hedge funds and all, a lot of times we use model values. As in, there are certain hedge funds and all which could be dealing into illiquid securities. If there are illiquid securities, you may not have a market price. For stocks which are listed, you'll have market prices, but there are a lot of strategies and all which might be involving unlisted securities and all, or illiquid securities, fixed income securities. There are a lot of fixed income securities relatively liquid, or maybe your strategy is such where you're using a model and all to do the valuation and pricing and everything. So again, when you're looking at models and all, they are again going to be smoothing the graph, smoothing the curve, smoothing the data. The actual market prices may react abruptly, and the actual market prices may move in a different way and may not have such a gradual move as compared to what your model is predicting. Again, the same thing, your model is going to be predicting, smoothing the data, understating sigma and correlation. If you're understating sigma and correlation, you're understating risk and overstating diversification benefit. Sigma understated, you're estimating risk. So I will assume that okay, hedge fund is this much risky only, let me put this much money over here, but actually hedge fund is this much risky, I should have put less money into it. Ultimately, my portfolio will not be very efficient. I'm going to end up over allocating my money into hedge funds under the misconception that hedge funds are at this level of risk, whereas hedge funds are at a higher level of risk in reality. Tell me, are you following this? So model risk is there, model calculations and all, my correlations and standard deviations will be biased downwards, and I will make wrong calculations and wrong judgments in terms of allocating my money to these hedge funds. Tell me, are you following this? Easy? Comfortable? Alright. There are a few terms which we need to understand when we are looking at hedge funds. So I'm looking at hedge funds characteristics. So these we've already covered. Hedge funds, one, they are allowed to use long, short and all. They're easily able to do long, short strategies, combine different positions. Second, they're also allowed to do short selling and all. We have short bias funds and all we've seen. Also, you can do variety of strategies, variety of securities. Like a mutual fund may not be allowed to invest in private company, in distressed debt. They might have those regulations, but hedge funds have a variety of options and strategies they could invest into. They can do derivatives if they feel like. They can invest into unlisted securities if they feel like. The restriction is you can't advertise. But in terms of you can take loans and leverage your investment. So we already understand these characteristics of hedge funds. Then there are certain terms you need to understand, right? Be very attentive over here. Now, when you're looking at hedge funds, understand the logic behind it. Why do we need certain terms? Why do we need this kind of arrangement? So, one, when we're looking at hedge funds, there is something called the lockup period. Now, what happens is hedge fund is not a regular strategy. Say, suppose you're planning to do a merger arbitrage strategy. Okay, you have invested money into merger arbitrage strategy today. Today, suppose the hedge fund has opened at time 0. You've put in a lot of money into the hedge fund. A merger, acquisition, etc. These deals might take 6 months, 9 months, 10 months, 1 year to complete. Okay, so your investment horizon is 10 months. So you have investors who have invested money into your hedge fund at time 0. Now after 1 month, one investor will stand, I don't want to invest, I want to get out, mera paisa wapas karo. Give me my money back. Now what will hedge fund do? The problem is you have already invested A plus T minus, A minus T plus and all, acquire, sell, target, buy, etc. You've already executed your strategy. Now the problem is that this guy is asking money right now. If you give him money, then you'll probably incur losses. And think about it. Let's say there are 10 investors. One investor wants to sell, he will take his money and go. Ultimately, the remaining 9 investors are going to suffer, because this guy will run away with his money. Now his strategy goes, his strategy gets disturbed, because these are not very liquid companies. They may not be very liquid, and this has a time horizon. It will take 10 months or so, 12 months or so for the M&A to take place, or for this strategy to work and give you profits. These are not liquid, that today I buy, tomorrow it will increase. It is not day trading or something that you're doing. So therefore this becomes a problem, and it is a disadvantageous to the investor who is actually staying invested. The 9 that are staying invested, they are the ones who will end up suffering because of this one guy who wants to get out of the hedge fund. So first of all, you're a qualified investor. You must have understood what hedge fund and all is when you're getting into this kind of a complicated investment structure, and you have that kind of money, so you must have done your due diligence and all. So you please be careful before investing. So that is why we have certain restrictions. The hedge funds are going to be having certain restrictions imposed. So one of those restrictions is going to be lockup period. So can you understand limited partnership and all? I've told you limited partnership, general partnership. We'll discuss the structure and all in more detail later. But first of all, when you're looking at this one, there is a lockup period. Lockup period is, suppose if you're investing into a hedge fund, your lockup period is you cannot withdraw a single penny for the first 6 months. So there is a lockup period. You cannot withdraw a single penny for the first 6 months, or let's say for the first 3 months. So that is called a lockup period. Excuse me. This is fine. Now what happens is there is something called a soft lockup period. So maybe somebody is in absolutely dire needs of funds, absolutely desperate requirement for funds, and that time you say, "Nahi, paisa de diya, it is lockup period 6 months." It may be, maybe the investor is not comfortable investing in such a situation. They may not want to invest in this hedge fund because you're giving such strict terms like, there is no lockup period and all that. So what do? We need to think of an alternative. We need to think of a way out. So there is something called, might add another clause in my hedge fund agreement, in my hedge fund deal, that is a soft lockup. What is a soft lockup? So first of all, the lockup period is 6 months. You cannot take your money out for the first 6 months. If you want to take out money out in the first 6 months, you will have to pay a fine of 4% or 5%. So you will have a deduction of a fee called 5%, let's say a redemption fee or something. So this is a soft lockup. Why is the word soft being introduced over here? That okay, lockup period hai, but it is not like a lockup period where absolutely you'll not be allowed. But if you are still so desperate and if you're willing to, then okay, pay a 3-4%. Let's say we'll be charging 4% kind of a money or a fee, and then you can take out. What will be the advantage of this? Because in case of this 4% that is being charged over here, it will compensate the losses that the other 9 investors will have to bear, because you'll have to take out money from this strategy and pay this one guy who wants to get out. Tell me, following this? So these fees, this soft lockup and all can be done, that for a significant fee. Now when you're investing 100 crore rupees or something, and then when you're looking at 4 crore rupees being paid and all, 4% is very huge amount of money over here when you're seeing this, right? That is your lockup period. Next is a notice period. So what is a notice period? Even if your lockup period is over, let's say 3 months over, 4 months over, whatever is your lockup period. Now 3 months is over, and now after another 5, 7 months or 8 months or so, suddenly today you will say that I need some money, I want to buy a house, or I want to make investment elsewhere. So today you will call the hedge fund manager, I need the money, kal paisa ready rakhna. Keep the money ready tomorrow. It is not going to work like that. Even after the lockup period is over, you cannot just simply say that I need my money today. You can sell mutual funds units and get the money tomorrow, because mutual funds are dealing in absolutely public equity. And every day the price of mutual fund, the value of per unit, etc. is disclosed and it's listed and all that. But you cannot do the same with hedge funds, because, and first of all, you don't even know what kind of strategy the hedge fund is doing. It's a macro, it's a relative value, it is what? And they all have their strategies. Their strategies take time. They're not trading strategies. Their strategies, convertible arbitrage, merger to happen, not happen, restructuring to happen, or short buy strategy. It is not that today the stock is overvalued, I short sell the stock today and tomorrow the price will fall down. You expect that the people will realize it will take 6 months in the market for the prices to fall down, etc. It takes time. So hedge fund strategy is not such a liquid strategy that today I want money and tomorrow I get it. So there is something called a notice period. What is a notice period? That if I'm asking for money today, let's say there is a notice period of 2 months, or let's say there is a notice period of 20 days. So if today you are asking for a redemption, there is a request, I want to redeem my investment, I want to take back a part of my investment. In that case, you'll have to wait for the redemption period. So the hedge fund manager will have a redemption period, let's say of 20 days. So the hedge fund manager is going to be using those 20 days to systematically think about it, find the opportunity, liquidate certain amount of money, arrange the funds from the investment, and then give it to the investor. So that what happens is that I don't have to suddenly sell the funds and book major losses and all. I get a good 20-day horizon or so in order to manage, figure out what to sell, how to manage, and take the money out, so that the other investors who are actually remaining invested do not get disadvantaged because of this. Tell me, are you following this? That is what we are looking at. So when you're looking at notice period and all, there could be significant transaction cost also. Because also please understand that you're not dealing with 100 shares, 200 shares, that okay, sell 100 shares in the market, give him his money back. I have 1 lakh shares, I'm holding 5%, 7% stake in company. I'm holding huge chunks. And when you try to sell 4%, 5% of a company or so, your selling pressure is going to pull the prices down in the market. You have a huge investment. When you have a bulk investment, when you have that huge an investment, it impacts the market itself. Me selling shares is not going to do a thing to the market. Are you understanding? But when these hedge funds are selling that kind of stake, that volume of shares and all in the market, it is going to create a major market impact cost. So that market impact and all also, that is why we need notice periods and all, so that during the time frame I'm able to manage the liquidity and all of that. Tell me, are you following this? So these risks are also there. So not only is there a liquidity risk from an investor's point of view, that will I be able to sell my money, sell my hedge fund units and hedge fund investment and get fair value in a short duration of time. Not only that, if another partner, another guy, another investor is taking his money out, there is a risk to the remaining 9 also. What if because of this guy's investment being redeemed, the strategy falters and the strategy makes losses, the strategy is not successful? My plan fails, the way I was planning to make profits and trade on it. So these problems are there, and therefore for redemptions also there could be redemption fee and there could be a notice period and all of that in order to gain the money back. Tell me, following this? Comfortable? Next is something called fund of funds. This is very interesting. Understand the logic. So basically there are a lot of problems. So one, I'm a hedge fund investor. Now I have let's say $1 million to invest in a hedge fund. Now which hedge fund do I invest into? Should I do a macro? Should I do a event driven? Should I do a short bias? Should I do a market neutral? I'm very confused. How do I go about investing into a hedge fund? And I have only $1 million. So I cannot invest in 10 different hedge funds which are following 10 different strategies because I don't have $10 million to invest. That is my problem number one. My second problem is that I don't know which hedge fund is good and which hedge fund manager is going to be successful, because we've already discussed that top quartile and bottom quartile managers have a huge difference in terms of returns. So it is very important that I get access to the top managers and all. That is another problem. Another problem will be that see, hedge funds cannot take unlimited amount of money. You have limited scope. You cannot sell, if say for example there is a company which has 100 million, which has let's say 1 lakh shares outstanding, I cannot short sell 2 lakh shares. I cannot take any amount of money. So whenever these funds and all are generally launched, they're generally launched with a maximum amount also. That we will collect a maximum of $30 million. We will collect a maximum $40 million fund. This is a $40 million fund. We will not collect even if there is more money. And don't you think the top hedge fund managers will already have their existing investors who want to invest in their funds? Because the top hedge fund managers are generating good returns. So whoever has been investing in their hedge funds in the past, they would only invest in that hedge fund. And the managers will also ideally prioritize those people who believed in them when they were probably starting off. The older relationships, the older clients, you'll always prioritize that. So now suppose I want to enter the hedge fund market and I want to be an investor into the hedge fund market. How do I get access to those top managers? Because the top managers want to stick to their old clients. Tell me, following? So these are a lot of challenges. So what do? There is something called a fund of funds. Fund of funds is like a mutual fund of hedge funds. Not exactly mutual fund, I'll tell you how and why, but it is like a mutual fund of hedge funds. So what we do is, these lot of investors are going to be putting all their money into a fund of fund. Now I'm still investing 1 crore each. It is not that you will be able to invest 1,000 rupees and 500 rupees and that amount is going to be accumulated. It's not going to work that way. That's a major difference with a mutual fund. So over here what is happening is, we investors, so let's say for example each individual hedge fund, the ticket price was let's say 10 crore rupees. Now it becomes let's say 2 crore rupees only. So fund of fund can reduce the minimum amount investment size, but not to an extent where retail investors can start investing. It will be ultimately still the HNIs who are investing. But instead of having a minimum ticket size of, let's say, 10 crore rupees or $5 million or $10 million, now the ticket size becomes, let's say, $500,000, $2 lakh, something like that. But still a very obnoxiously huge amount. Tell me, are you following this? So now what will happen is these investors are going to be investing into a fund of fund. This fund of fund also has certain managers. Now this fund of funds manager is going to decide which hedge funds to invest into. So first my question was that how will I know which hedge fund manager is good, which hedge fund is good? So fund of fund FoF is going to decide that. That is one. Second, also I am investing 1 crore rupees. All these investors are putting 1 crore each. Now this guy probably has 20 crores or 30 crores or 40 crores to invest, or 20, 30, 40 million dollars to invest. Now this guy can invest $5 million into 4 or 5 different hedge funds. I am getting exposure to 5 different variety of hedge funds by investing only $1 lakh or $5 lakh, and this fund of fund has got, let's say, 20, 30, 40, 50, $100 million to invest. So I have been able to diversify across hedge funds. I do not have to choose which hedge fund to invest in or which hedge fund manager to invest in. Second. Third, also my ticket size has also probably gone down. Instead of investing a $5 million, I am now allowed to invest, let's say, $0.5 million or $1 million. Third, this fund of fund has been investing into these top managers for a very long time. So even if I am a new investor into this FoF, into this fund of funds, I am getting access to a very good hedge fund manager who would not have accepted me. Maybe this guy is already full, he is already catering to his old clients. This fund of fund is also one of his old clients. If I want to directly invest, he's going to say that no, my AUM is shut, I'm not going to be able to accept any more new investments because my AUM is only $40 million or $20 million worth, and I've already got more than that. I've already got interested clients to invest more than that. So I may not get an entry into hedge fund 1, but this fund of fund has already been invested into hedge fund 1 earlier. Tell me, are you following this? So one, I don't have to choose which professional managers. I can invest a smaller amount of money, not small as a mutual fund like 1,000, 2,000 rupees types, but relatively smaller as compared to a direct hedge fund investment. I'm getting diversification across hedge fund strategies because hedge fund strategies itself are very different. So it is like a mutual fund of hedge funds for all, again, still rich people. Tell me, are you following this? There is one disadvantage that when these hedge funds, they will deploy strategies, they will do merger arbitrage, this, that, etc. strategies, macro and all. They will generate return out of those strategies. From those return, they will take 2% management fee, 20% incentive fee or so. So whether they make profit or not, if the investment amount is $10 million, they will take 2% of 10 million as their management fee. And if on that 10 million, they're able to generate a profit of, let's say, 2 million, out of that 2 million, they will again take 20%. So they will take a share of profit and a management fee. After the fees has been deducted, they will give those returns to FoF. FoF is the client to hedge fund. They will obviously deduct their fees and then give the return to a fund of funds, net of fees. Now, fund of fund also, this guy is not doing any charity for you. But fund of fund is not deploying strategies. They are involved in choosing hedge funds and all. So their management fee could be 1% and 10%. They will charge 1% of the asset under management and 10% of the incentive fee of the profits created. They will deduct their 1% and 10% and then provide net return. So basically, if you see, there is double layer of fees till the time the returns are generated and given to the provider, to the investors, to ultimately the investors. So double layer of fees is a disadvantage over here. Double layer of fees becomes the disadvantage over here. Tell me, are you following this? Understanding what is fund of funds, why do we need fund of fund, and what is the disadvantage of fund of funds? The disadvantage is only the double layer of fees, but obviously you're getting an advantage over here in terms of investing into variety of hedge funds, getting access to those hedge funds, selecting of those hedge funds. Tell me, following this? Normally the fees used to be 2 and 20 and all, but nowadays it has come down to 1.315 and all. Competition is increasing in the hedge fund industry as well. There are different hedge funds who are attracting capital, who are attracting investments. At times investors feel that 2% and 20% is very exorbitant. We'll do the fees calculation all separately, so don't worry. But 2% of your asset under management and 20% of your profit and your incentive basically and all. We'll do calculations. We'll do the exact calculations and all later. But now because of competition increasing in the industry and all, this is being reduced to almost, it's ranging around 1.3, 1.4% and 15% of this incentive fee and all. Even Hedge, FoF is reducing their fees. So there are fund of funds where they don't take any incentive fee, they'll only take that 1% management fee in order to allocate your money into these hedge funds. So it's possible that FoF might do away with 10%. Tell me following, understanding what is fund of funds all about, right? So as competition increases, obviously the management and all will have to reduce their fees. Kuch puch raha hai? All good? Comfortable till here? This completes this part.